Markets with May. And today we're going to be doing SoFi Technologies. SoFi or not so fine. Look, sometimes it's hard to get titles. All right, guys. But I've been wanting to do SoFi Tech for a while because I get it requested a lot. It's such an intriguing business. It definitely has taken the neobank community by storm. And there's a lot of extra stuff going on here, but all in all, I would say that it's definitely one to watch for this earnings season. Okay, past performance is not indicative of future returns. I will also mention that I do have the world's smallest position as a strangle on this one. So, and that really indicates that I do think that there's a strong argument that this could go either way. And I'm just going to present it as it is from the fourth quarter. To be fair, for it to be a more meaningful position, other than oh my gosh, isn't this fascinating position? I would need to do probably ever so slightly more research, not too much more, because it's not a very old business. So it's not like massively complicated, so to speak. But because of where it sits and what they've done to try to make it work, it's really, really fascinating. I will say that. Now, I do want to mention that going into earnings season, because I'm noticing that depending on where people came into finance or where their expertise is, they really look at the market, the banking crisis, and all that stuff a little bit differently than I do. And I really want to go through in the next couple of days. I'll do a presentation on what is your financial organization and when does it have to own up to its held to maturity. In other words, I'm going to try to map out a bit better for folks liquidity risk, because I noticed a lot of people are trying to do massive valuation work to try to figure out if someone has toxic assets or something. Again, we've had no credit issues thus far, but if we continue to have weakness in liquidity, which is its own type of risk with its own type of stuff, then you do then have the other types of risks being accentuated: duration risk, credit risk, et cetera. But there, for some reason, although you can see me clearly break it out in nearly every video that I do, there's some misunderstanding of what liquidity risk is relative to credit risk and duration risk. And that's a problem, because as everyone that trades actively, especially the meme stock, knows, liquidity risk moves significantly faster, more painfully. It's harder to correct later than any other type of risk. Liquidity risk in the exact opposite version of a liquidity crisis is, like I said yesterday, a short squeeze. And the rapidity, the speed and velocity with which that can happen is also true when you have a liquidity crunch or a liquidity crisis. So I'm going to lay some of that out tomorrow. Please do follow me if that's interesting to you. But let's get into SoFi. Like I said, this is, to me, strangles as far as that goes, because it could go either way. And, for those of you that are very familiar with SoFi, this probably isn't going to come to you as any surprise, but I would say that this was really on the quarter. This is where a lot of folks were like, May, I've asked you for months, please cover SoFi. And then this happened on the quarter, which is it went straight up from around $5.70 all the way up to $7 and then straight back down. So this does have some of those meme aspects to it. And really, as it's floated down, at first it was just market correction, but then after that, it really was all the other stuff we've been seeing in the banking system as relates to Silvergate, Silicon Valley Bank, Signature, so on and so forth. And so now it's kind of leveled out here, and people are like, well, May, it's a neobank. It has certain attributes. What do you think? And so my initial take is, I really like them in some ways, but they have to survive like everybody else, and it's not going to be that straightforward. Okay, so on the quarter, why did it do so well? Revenue was up 60%, and that almost all came from net interest income, up 326%. The other income is only up 18.6%. That is why I'm going to be doing this presentation tomorrow, because this is massively misunderstood. Interest rates rise, improves net income, does something else depending on what is going on with the actual mix of assets. Every single bank, including Silicon Valley Bank, benefited from the improvement in interest rates as relates to net interest income, but they took it on the chin elsewhere, which we will talk about tomorrow. But for now, this is what we got. I want big improvement in net loss. They are still a bit of a startup, and they did an acquisition on top of it. They are cash flow positive despite this loss, because that is not how you look at financials when you've got a bunch of stuff going on that is above and beyond just everyday business as usual. And then dilution was up 13%. But in general, as you can see very clearly from the chart, the market was really stoked about this relative to what they thought was going to happen. And that has to do with what it was looking like in previous quarters, et cetera. Fair and square, this was a good quarter. Okay, now, a lot of times people will be like, well, what exactly is it that SoFi does? And they'll throw like 3,000 things they think SoFi does, including crypto. And I will show you crypto at the end, but that is not an issue. That does not appear to be any major, like, that ain't the thing. Okay. For all the things that I think that will help them, such that I would do a strangle, crypto Inc. It does at this point doesn't look like the thing that you need to be worried about. Okay. This is really the way that they divide out their business: lending, tech platform, and financial services. But the easier way to think about this is there's the part that's the bank and there's the part that is not the bank. All right. And the not the bank business is the original business, the OG business, I like to say. And what is the original business of SoFi? Okay. It's not crypto, guys, as much as some people like to put that in the comments. The original business for SoFi is student lending. That is what it is. And it has tried for many quarters to diversify away from student lending for good reason. I will show you exactly why student lending, even more so than autos, I would argue, is like not where you want to be right now. Okay, so before we get into that though, just a couple of things that are part of the positives of it is they have a very big CET capital buffer. This was not the case when they first did the acquisition of the bank. So timeline. In 2022, beginning of the year in January, they went ahead and positioned the OCC to become a bank, properly become a bank. And then February of that year, they closed on an acquisition of Pacific Golden, what was the name of it? Pacific Golden Corp Bank. They acquired it. Okay. And so this CET buffer actually is significantly better than it was before. It was, I think, at the beginning of the year, they've been all along reserving higher and higher amounts of CET capital. Now, there's a bunch of people out there very focused on duration risk, but I will say that the majority practitioners that I've seen are actually looking at it this way, which is the way I tended to look at it even last year, which is cash as a percentage of deposits, which they're now calling CAPD, which I think sounds like a very gangster abbreviation. So I'm kind of stoked that you could be all about like, what's your CAPD? Do you know what I mean? But that is what it is. So CAPD is cash as a percentage of deposits. It is basically you take the cash line item and you divide it by the deposit owed. And the difference between this and looking at duration is they're thinking about it the same way I am, which is what is the liquidity risk? In other words, once they go for the door, how fast how many people need to go for the door at the same time before you have a problem? And if you do the CAPD calculation from year end, you have 19% on unrestricted, and then you get into restricted cash, which you're not allowed to do. All right. And that will get you to 24% before you touch any of the available for security stuff. I am giggling because there are some fun chats. You guys make sure you watch the comments. There's some really great people there that stop by and also comment. All right. So that's CAPD. This is actually pretty strong. Just for the record, most people's CAPD like this. Okay. And I just want to show you the relationship between these two. CAPD mostly is going to be very close to CET capital buffer. Okay. The only difference is the available for security sales and how you're thinking about them as tier one capital and what percentage they compose and the nature of them. Okay. The nature of them. And does the nature of that have any duration risk at this point? So those things are all true, but using CET as a proxy for CAPD usually would have been fine in this particular marketplace. Now we got to create another set of acronym letters that we're all going to learn. That's what CAPD is. Okay, moving right along. Well, this is another view of the balance sheet, and I just want to show it to you. The restricted cash and restricted equivalents, these actually, so that's just, so the cash and restricted cash, that's what we're using for the CAPD calculation. This is cash if people want it back, this is what they could actually liquid have at any given moment. They are SoFi, so meaning like most of the people are going to do it via electronically. People I think that's why people are concerned for them. The other things that we're going to look at here are loans at amortized cost, because these two other assets are very much something to monitor. And most of the loans amortized at cost are credit cards. I'm just going to show it to you very clearly because they do great divisions. And then the other investments are actually stock investments in First Republic and FHLB. So just realize there's some of that going on, but it's tiny, guys. It's tiny. Don't be mean. Don't be mean. Okay. It's a very tiny portion. That's why I'm saying that if they can get through this period without losing any deposits, because remember, deposits, the only thing that keeps deposits in your bank is people not wanting to change banks. That's it. And so you never know what's going to happen, but that's the number that we're looking for. And then after that, it gets hairy. But I feel like if they can manage through this period, this actually looks pretty good. Now, I'm going to tell you that they give better, just if everybody could give disclosure like SoFi gives disclosure, oh, I'd be so happy. My life would be so easy. I'd be able to say such very direct things. But no, SoFi actually gives fantastic disclosure, for better or for worse, for themselves, but definitely for the better of investors to understand what's going on. This is their loan maturity portfolio. We went through yesterday or 2 days ago some duration risk proxy stuff using a zero coupon bond, so you get a sense for this. But 40% of their portfolio is older than 5 years old. Okay, so then we have to look at the way they're hedging as well. But 40% is that age. If you 4+1 down below, you can see is 5 billion. So then you get a sense for how am I thinking about this. And then the other 60% expires within 5 years. So I mean, you could still take an L on something that's 5 years in duration. It's really hard to say, but it's still a bit more liquid than some of the other stuff that might be out there. Because if the market really truly starts to seize up, then you will it'll seize up on the longer end because the nature of what's going on right now. And you'll still be able to liquidate stuff that's like 1 and 2 year, and then 5 years a little aggressive. So in my dream world, this would be a little bit more granularity, but honestly, this is better than I've seen in other bank reporting. So I'm a happy girl on this. Here is this. I love that they do this. I mean, you guys know this is my pet peeve with Upstart all the time, is they don't give me any kind of sense for, they just scream FICO score and then don't tell me anything about the composition of it. But here you can see that all of their book is very high FICO score. Now, I want to point out some things on here that is what makes me a happy girl, as far as trying to say strangles is probably the right way to go, both long and short. And what I'm seeing here on the FICO score is that, first of all, it's all 700 plus on average. So probably some lower, probably some low, and obviously you can have some skew. Yeah, all that stuff. But this is a very high FICO score. And and I think he said the majority of his book, he did a talk at Bank of America's conference, and I think they were saying like 90% is prime or better. That's fantastic for me to know if I'm worried about you. But I also want you to very clearly see what the interest rates are. The interest rates is what the company's going to make. That's part of the reason why the net income, the net interest income can be so high, because it's your composition of your book. Now, they moved it out of student loans, which you can see goes from 2.8 billion in loans last year to only 877 this year. So they pared that down aggressively. All right. And then also, even on home loans, that's down a lot, but that's probably not them paring it. That's probably the housing market being not so much fun these days in general from a loan writing perspective. Okay. And almost all of it's coming from the growth in their credit portfolio, credit loan, personal loan portfolio. And I would be unhappy about this if it wasn't the case, and I don't think I put the slide in here, that they were also seeing about 35% client growth. So this massive increase is actually collaborative with growing just the raw amount of customers, and they've been able to maintain the FICO scores. This ain't bad. Now, it also means that part of the reason why the CLO market for personal loans isn't the first to dry up, so to speak, because you definitely have unsecured credit risk, is because the rates that you get on it are beautiful. Relative to other formats. Relative to housing loans, your rates aren't that great, but you get to take someone's house at the end. So there is that. So hence student loans are kind of the worst place to be right now. The other place would be auto loans. And auto loans are particularly weird right now because used car prices have dropped so aggressively. Okay, that's really the different ways to look at the loans, and hopefully that helps. Okay, so now other slides, the loan mix. You can see very clearly they really do provide this in a lot of different ways without giving you the actual loan itself and stuff like that. But you can see that the mix is absolutely they increased personal loans by 81% as a percentage of the mix, and then dropped it in the other two areas because of the way that they were looking at the marketplace. Charge-offs. I think this is close to the end here. Charge-offs I want to talk about because we have not yet seen credit losses. And in other banks, this is baby little tiny smidgen higher than other banks that I looked at last quarter. Okay. It's not high though. Historically, if you Google search this, you'll see that FICO scores that average 730 will have a loss ratio between 1.9 and 225 basis points. So 1.9% of all the loans you write with that FICO score are going right, and then 2.25%. And the difference, that seems like a lot to some people and really is in the debt market world. But what you want to know is why there's like differences is that the calculation method on loss rate can vary depending on how old the data you have. So if you just took the last 5 years that were great, no one's defaulting, then yeah, you're going to look like a champ. But if you take 10 years, 20 years, what have you, then it's going to be closer to that 225. So we're still at 1.86% losses. We're still below historic, in my opinion. Okay. So this quarter, we're going to be watching for what that loss rate goes up, because right now we have a pure liquidity crisis, in my opinion. Some people disagree. Some people think we have a duration mismatch crisis. But to me, you really got to address the liquidity first before you go to the duration in a lot of ways, or you have to address them both simultaneously. Regardless, no one is saying we have credit losses going up right now. Credit losses going up, that there's almost nothing you can do about that point. When people are just defaulting because there's no capital, that's when you start to have a problem. That is a little bit of a bigger uptick than I would have expected, but it's in line with some of the other folks. But okay, I'm gonna just say it. If you have a 730, if you have a group of 730 FICO scores and you went from you went from a loss ratio of 60 basis points, which is why I told y'all upstarts can do as much math as they want. They psycho if they think that is actually the right thing. So if you went from 60 basis points of loss to thinking about this way, net charge-offs of 133, that's a doubling, then kind of got to we got to watch this. We got to monitor this. Okay. That's what we're going to be looking for this next quarter. Other last little baby things, hedging. All right. Here's the thing. A lot of people would be like, but you can hedge. Hedging's so easy. You know what? Ain't no hedge without a cost. Okay. Let me tell you. So that's what I have to say. 6.8 billion is the notional value of the hedge they have on, meaning given what they paid in the marketplace for them, which they're structuring them as swaps and a couple of other things, 6.8 billion is what they have hedged. Now, going back to the earlier slides, I want to show you this. Okay. This is what they have currently in the loan book. And they're going to basically write these loans, securitize them out, as best they can. But if we want to look at, oh goodness, my face is right on top of the number I want you to look at here. I'll raise it up. If you look at the bottom part of this 5 to 15 year, you're at 5 and change. Okay. So that's actually pretty, to me, that's pretty well hedged. Okay. But other people may feel differently. Now let's talk about the nature of this hedge. Some of it, we don't know actually what the nature of this hedge is. I'm going to say that. We won't know. They'll talk about it hopefully more. But essentially, the way that it's written in the 10K, which is where all this data is coming from, okay? And then also the Q. It says the following table presents the notional amount of derivative contracts outstanding. Oh, I didn't write it. And then there's a bunch of footnotes that are associated with it. But if you look down below at how they're dividing it out, it's interest rate caps, derivative contracts to manage securitization investment interest rate risk. And then there's a bunch of other stuff. All right, I'll just cut to the chase. What you need to know is that they're still in the business of writing loans. And depending on what happens, if they're writing the loan and then they're going through origination, like when you go to get your mortgage, you get your rate, it gets locked. Then there's all this stuff that happens for closing. And then maybe 30 days will pass. If you're in New York City, 90 days can pass. Okay. It can be really painful, right? And they have to confirm that lock, that they locked you in at that rate. Some of that derivative contracts is that. Okay. A lot of it's going to be that. And then some portion is actually the hedge duration risk. That's what we're seeing. And so it's really unclear which portion is which, but I got to say, they definitely spend money on hedging the book on interest rates. Just FYI, in case that was unclear. And then sometimes they have to take an L, like everybody has to take an L. But what I would finally say on that, final thing on crypto exposure is that there's not much of it. It's mostly the custodian business. It's not like it's being some big fancy thing against it. This cannot be the thing that you worry about with SoFi right this minute, okay? But just going back again to this concept of hedging, there is no hedge that isn't a bet. Okay, so in with duration risk, you can hedge out your duration risk, but you're taking a bet when you do that as well, that interest rates are going to do a particular set of activities, and then if you're wrong, you will take a loss, which could be the premium depending on how you hedged it, or it could be something else if you have some kind of floating instrument that moves with it. If you're confused about this, you literally need to look at anyone's earnings as relates to their currency hedges in last year. And you will see that there is no such thing as a free lunch when it comes to hedging. And that's all I have. I don't really have a ton of questions. Let's move to questions. Okay, we got a lot of silliness because you also think Cap D is pretty funny, which I love. I agree. Okay, everyone is pulling out their money from the bank to cover margin calls with brokerages. You know what, Israel? There's some wisdom to that some of that might be happening. I can't deny it. Liquidity is drying up. It is. Okay. Anyone that thinks that it is not, it absolutely is. And it has been, in fairness, since last year. That's part of the reason why I was so weird. So why I was like talking about it with Upstart last year and had a lot of angst associated with it from others. But that was my concern, was liquidity drying up. It'll dry up first and foremost in the places that are closer to, that are riskiest, so to speak. And I'll go through that tomorrow to show you kind of how capital flows through the system, because it really is, there is a map to this, and I would say that most people don't bother studying the map because they have a very specific slither that they're focused on. Unfortunately, because of some of the roles that I've had, I haven't been allowed to just ignore where the money comes from and where it goes through. And if they need it back, what's that mean to me, so to speak? But it essentially, the fractional reserve system itself is always going to be subject to some considerations related to liquidity risk. And the people that should know this the best will be over like my age, approximately my age, and actively participating in the risk management process in 2008. Because any math you did just in your own little niche would have failed you unless you also did the exogenous risk of money coming out of the system. That if you didn't do that, then if you were anything related to hedging, risk management, portfolio construction, you would have taken it on the chin because you would have missed the biggest risk that was coming at you, which was liquidity risk. Angst. You're so funny, Israel, teasing me. Yeah. I don't think it's 16 billion. That number seems wrong to me. They got about 5 billion in operating income, and then they've got about 5 billion in debt, another 4 billion in operating leases, and 300 million a year that they spend approximately in debt, in debt payment, debt expense. So any kind of chopping off of that debt actually improves their circumstance. I'm not sure where the 16 billion comes from that people are talking about. Feel free to stick it in the comments if I'm in error or I'm missing something you're seeing. And also AMC folks from yesterday, there are some great questions that came in, and I need to do a little bit of work on exactly the nature of the announcement from yesterday and how that will float through to the exact timing of when you would get the 7-for-1 and all that other stuff that's going on, and what the implications then are for your existing positioning. So I do owe you guys that in the next couple of days, hey, I got to get my taxes in, guys. It's tax season. Make sure to pay the government. They need your money more than than ever before. Other questions? You guys are so funny. You got really creative with this. Okay, I think that's it. Okay, yeah, they do. Yeah, definitely. Because the first where they started was in student loans. They gave better student loan rates than the US government did or other banks gave. And they used the alumni network to do it out of Stanford. That's where they started. And I think that's it for comments today. Definitely appreciate people writing stuff in my comments. It gives me great show ideas. Hope that was helpful. I'll see you guys next time. Bye.